which specialises in advising investment managers around the world on ESG and responsible investment practices. Daniela started her career at Goldman Sachs in its hedge fund consultancy business, and then worked in senior positions in investor relations and ESG at Arrowgrass Capital. Welcome, Daniela. There's a lot to cover, but first off, thank you for joining us at 10 p.m. I think London time.
That's right.
Obviously, you advise clients in multiple time zones, so this will be familiar territory for you. But I also understand you have a New Zealand connection through your husband, so this probably feels very normal.
Yeah, no, absolutely right. No, pleasure to be here. Thanks for having me on.
Great. All right, well, let's start with you and your role at Dainsmead and the type of clients you look after. Why do they come to you, and what are they looking for?
Of course. So the Dainsmead ESG businesses have been around since the beginning of 2020, and really it was just in response to sort of demand from investment managers for help with setting up their ESG practices, and that's both within their own businesses in terms of how they run their businesses, but more importantly how they run their investing, how they run their funds essentially. And we just saw increasing demand for sort of guidance around how to implement these sort of practices. What does everything mean? How to keep their investors happy, and especially in sort of non-standard strategies and products. So we work with all the different investment managers, but a lot of them are hedge funds and private equity managers who are trying to navigate something that's already a little bit confusing, but also in a strategy that's often a bit more complicated than a sort of traditional long only. We've also sort of diversified more recently into so sort of, I guess, upwards and downwards of our clients. So the allocators into hedge funds, but then also the portfolio companies of some private equity businesses, especially those that are sort of private companies, but maybe thinking about IPOing in the next 12 to 18 months and realising that ESG needs to be something they can talk coherently about to potential future investors.
Fantastic. And so you have clients in multiple jurisdictions, is that right? So where are they predominantly based?
Yeah, we're about a third UK and Europe, about 2/3 US. I realise this is not going to add up to 100, but we have a couple of Asia clients as well. But yeah, at the moment, primarily US. But I'd say a year ago, that was sort of 2/3 Europe, 1/3 US. And so we've definitely flipped in the last 12 months.
Interesting. And so, I mean, with your clients, are they sort of externally, do they appear to be ESG focused, or is it something that is evolving?
It's very much evolving, and we should be really clear as well that the majority of our clients don't run sort of ESG labelled products. Some of them do, but the majority run normal strategies, just sort of with a goal of maximising returns. Essentially, they don't necessarily have sustainability goals or targets or objectives in their strategies. Some of them do, the majority of them don't, but they're still facing a lot of sort of pressure from investors to articulate and sort of formalise how they think about ESG issues within their investment processes. And that seems to be the sweet spot where they aren't experts because they don't need to be and shouldn't have to be, yet they're still being asked to really prove this point. And yeah, that's where the sort of niche is.
Okay, and I guess that's probably the great point to sort of circle back. So let's talk about what is ESG and why is it important, and how is it that it's central to investors' minds but isn't, on the tin as such yet?
I know, it's a really good question, and I think that ESG does mean different things to different people. I think this is why people spend a lot of time wondering how to address it. And it's probably really important, I think, to set out from the beginning, ESG is a really subjective concept, and the issues within the bracket of ESG are all, or many of them are really, really subjective, which makes it quite complicated. And what's happening is a group of people who are quite analytically minded, typically, investors like facts and data, and they like to be able to sort of look at inputs and convert them with their methodologies into their sort of outputs, are suddenly being asked to formalise views on very, very subjective things and kind of define how they think about it in a really systematic way. But that's I think we're sort of confusing two skill sets, and they aren't always perfectly aligned. So I think that's kind of a good starting point. Everything here is very subjective, and when we talk about specific ESG issues, it's always important to remember that one investor will think very differently from another about whether this is an issue. In terms of kind of I guess what people are doing or the approaches to it, I think it's also important to clarify we have all these interchangeable terms around responsible investment, socially responsible investing, ESG, there's thousands of others, and they all are used quite interchangeably, which I think is also quite dangerous. And historically, ESG simply just meant exclusion. So essentially just investors avoiding certain sectors or industries or activities based on like either ethical beliefs or sometimes religious beliefs, all sorts of kind of moral reasons. And we do still see that does still happen, but not normally on its own anymore. So the ask has, like the bar has raised here, and the ask is more about the sort of systematic inclusion of ESG issues in the way that you think about investment analysis and making investment decisions. So really from a sort of due diligence perspective, with a goal of managing risks and improving returns by having considered those ESG issues. So really it's not saying we want you to be the greenest of suns, but we want you to protect our income and our returns from ESG issues as well as financial issues. At the other end of the spectrum, we obviously still have sort of thematic and impact investing, where there is a defined and measurable sort of sustainability goal, which is a great thing, which is happening. But I think this middle zone of just simply integrating ESG and using ESG in the kind of due diligence process is where everybody is being asked to get to, even those that aren't trying to kind of achieve some kind of impact.
And so when you say the due diligence process, you're talking about when portfolio managers like Mark and Andrew are considering the investments that they make, and then obviously the knock-on effects of when capital flows into those investments, what social or other impacts it can have.
Yeah, exactly. That's exactly it. So when in your normal process, whatever sort of financial analysis process you normally do, the idea is that you also need to be thinking about ESG issues along with that. And the majority of the time, that's already happening. And these things aren't new. Like, these aren't new issues. It's just that we're now being asked to better articulate how we think about them and do so in a structured way rather than in a sort of ad hoc way. And I think when you get into these conversations, and we have a lot of conversations with a lot of different investment teams, initially they're usually a little bit concerned that we're going to ask them to significantly change something about their process. And often a big part of it is just articulating the ESG elements that are already going on, and then potentially enhancing, not changing your goals, right? But adding in elements that might be different. And I don't know, maybe we could sort of illustrate it with examples a bit better. But I think when we think about environmental issues, for example, we are aware of potential future regulation, let's say, in the way that we can use certain energy or the cost that we may face by doing so. It's those sorts of things that we need to make sure are being factored into business models and the way that businesses operate. I would be very surprised if investment teams weren't already thinking about those sorts of things if they're sort of on the horizon. But it's about thinking about them in a way that you can prove you've thought about them and shown how they've been integrated into the decisions.
Danielle, just on that topic at the moment, when we look at companies, we tend to be certain sectors where we really want to see some companies are making big steps forwards from an ESG front. So, for example, if we're looking at companies in the chemical sector, which might burn a lot of natural gas, so they're not natural gas or oil producers, but they use a lot of these products, we want to see what they're doing to kind of limit their use or improve their efficiency. And the same might be said in, say, a mining industry or something in the metals or mining. So, again, they're not restricted from NZ Fund's ESG policy because they're not, or these companies aren't actually producers of carbon gases and oils, but they are heavy users of those products. So from the clients that you work with or the advice you provide, how do things change from a sector perspective? Because obviously ESG issues, even if we just enjoy put oil and gas to a side, but say focus on more sort of chemicals or metals and mining, they have very different ESG consequences than, say, a technology company, which is maybe more focused on the governance side.
Absolutely, and there is huge sector sort of differences and also appropriately different expectations across different sectors for how far they need to go in some of these things. And your illustration is really useful there because that's you've touched on a point of like it's very difficult to sort of know how far to go with some of these things and where the line ends. So for those who do have exclusions, like you say, you can exclude those things, but you don't necessarily extend that to the businesses who are heavily dependent on them. And the main responsibility for an investor, in my opinion, in that context, is making sure that you feel those businesses are resilient to the sort of adaptation required to move away from or to use more efficiently certain energy. So there's definitely big sector differences. There are some really, really useful tools that a lot of our clients use. I'm sure you're familiar as well. Things like the Sustainability Accounting Standards Board has a sort of materiality map that helps to guide investors as to the most relevant ESG issues for different sectors. And it's a sort of matrix of sectors and issues. And it's basically just a heat map of it. And there's other sort of tools like that that's definitely been very helpful in trying to understand, okay, what's the most material for this sector? What do I need to really, really focus on? Because there are so many different ESG issues and everybody's, there's already a lot of things to consider. It's definitely useful to sort of focus the relevance. What's also been interesting, I know we might talk about issues of regulation later, but some regulators as well have the ones who have started to require certain, I guess, disclosures and kind of considerations to be taken place in the investment process, have done so in such a way that they've said, do so where this is material and relevant. And I think those are really important kind of concepts, I guess, in terms of, as an investor, just limiting what you're focusing down to what is exactly those things, material and relevant to that particular sector or opportunity.
Which gives, which is an interesting sort of segue to regulators and the regulator world. And I imagine that, I'm aware that there's a range of different sort of activities from governments at a governmental level, and then, as agencies of the government's regulators and different approaches. Do you want to, I guess, explain at a global high level how the regulators are approaching it and the sort of key differences you're seeing, disclosures, I guess, being a key focus currently, and how that might evolve?
Yeah, for sure. I think we see regulators trying to solve achieve two main things. One is to do with disclosures, and the other is to do with sort of like classification and clarity. So on the disclosure side, that seems to be starting primarily on climate-related disclosures. So we've seen that from loads of key regulators. The UK has done it, Europe, the US has recently just launched that for corporates, not yet for investment managers. Hong Kong, Japan, New Zealand obviously has its own version for financial firms coming in from next year. And the majority of those are basing disclosures on kind of recognised frameworks like the TCFD, which has been really, really useful. And we've been involved in lots of those consultations with different regulators in terms of helping inform how we think they should align them. And one of the things that the SEC did very well, I think, was basically ask the question of which framework should we use so we don't duplicate, because this is a global issue, and investors often look very globally across different corporate disclosures, and the ability to compare them is obviously really key. So that's been a really, really good step forward, but it is very much a sort of first step. So most regulators are just mandating the disclosure, not any action, but simply the collection of data, usually around GHG emissions, carbon footprinting, that kind of information. And how, TCFD has a lot of qualitative kind of disclosures as well around how management has responsibilities and the kind of how you manage those risks, as well as some metrics around them. But that's, to me, that's like sort of step one in, you have to measure it and record it to start to then mandate it. The other side that we're seeing is on the kind of classification side. So Europe's taken a big step forward in this already. They released a piece of regulation called the SFDR, which is the Sustainable Financial Disclosure Regulation. And it has a sort of extraterritorial reach. So anybody marketing into Europe also is kind of caught in scope for this. So this has become quite a global piece of regulation, even though it's a European-driven thing. And what they've asked investment products to do is identify themselves as one of three different groups. Article 6, Article 8 and Article 9 is what they're known as. And essentially Article 6 means that you don't do anything specifically ESG related. You may integrate ESG issues, but nothing particularly ESG focused. Article 8 means that you have to have a sort of environmental or social characteristic promoted by that fund. And Article 9 is sort of more impact, so you have to have some sort of sustainable objective. And what that's really helped with is it's helped investors understand whether the product that they're investing in has met, I guess, certain sustainability standards. And I think before we had anything like this, it was very difficult for anyone to make those determinations. And I mean, we've seen a lot of articles in recent months, I'm sure you have as well, around such and such investor thought they were investing in a product that was called ESG and thought it was going to be a very, very clean product, but actually they probably confused ESG with the concept of impact, and they probably thought they were investing in something that was more impact related, but ESG in these contexts often just means they are considering ESG risks in their investment processes, which essentially is the risks of the world on the company rather than the risk of the company on the world. So I think these sorts of regulations are going to help to clean some of that up and remove that kind of nuance. It's very early days though. That's the first of its kind that we've seen. That came out last year. The UK is working on its own version, which will be a sort of proposed to be a 5-part classification. And I expect to see more and more of these sorts of things coming up in the future. But I think it's a really useful tool, and I think it's what the industry needs, because I think there is still a lot of confusion about what is truly sustainable and what isn't.
Okay, and so are the states looking to Europe and to follow suit, or are they sort of carving their own path?
I think there's a slightly different political landscape there, and I won't sort of comment on that necessarily, but I think that it doesn't seem as sort of clean. They have followed in the sort of disclosure path, and they've started with corporates, and they will follow with asset managers. I've not yet seen anything on sort of classifications, but from a regulatory perspective, the SEC, they came out last week with an update of their sort of 2022 examination priorities, and ESG is sort of very much on their list. Their big focus is, and I suppose this is sort of in somewhat the same kind of idea as this classification idea, but their big focus is, if you say you do something from an ESG perspective, we need to see that you're doing it. And the big problem is if you say that you're doing something you're not doing, as with all sort of SEC type exams, that's always been the case. But so I suppose they are kind of asking for that clarity, and they're not saying we want you to do this, but if you say you do this, we need you to be doing it, and that's their main focus, really.
Right. Okay. And I guess all of this is underpinned by the idea that disclosure, once classified, will drive a bunch of changes in the investment landscape. And right now, that's the problem. And so it's assuming that investors will go, okay, we want to see, assuming the regulators' goals are what they are. Do you think that it will transition across to mandating at some point, or at a soft level, and then presumably a harder level, or is that not in scope for regulators?
I think it's hard to think that it won't eventually ask. Well, it's hard to think that regulators won't eventually start to suggest that some minimum standards need to be met, and I think that they will. Countries have made commitments that need to be sort of fulfilled by the corporates within those countries. So it's hard to think that won't eventually happen, but I'm sort of not an authority on whether that will happen or not, but my opinion is that I would expect that eventually. But I think more imminently what's likely is investors are increasingly making sort of commitments and pledges to invest only in companies that meet XYZ standards. So there's been a heap of extra sort of initiatives that have come out of the last few years, like Climate Action 100 and the Net Zero Asset Managers Initiative and Stay on Climate, and there's absolutely loads of them, but all of them kind of have a similar purpose, which is investment managers making commitments that they will only invest in companies that do X, Y, or Z, or that they will work with companies, better still, to make climate action plans or to set net zero targets and these sorts of things. So I think the pressure will come from investors probably before it comes from regulators. And I think that's the same thing as we've seen with other parts of these regulations that have come out. Investors have been asking for clarity and transparency, and that's what regulators deliver. Investors have been asking for sort of classifications, and that's what investors have asked them. So I think eventually we will get there, but probably just as a result of the pressure from investors on companies, that will happen much quicker.
Right. It was mentioned earlier that in the technology space, governance is more sort of focused on, and whereas in other sectors, climate change is one, and then there's obviously the social elements to the ESG, I guess, approach. well, obviously climate change, because of its nature, is getting a lot of attention, but that's moving across. Are you seeing developments in the other two areas and that evolving more?
Yes and no. I mean, climate has, for obvious reasons, very sort of economic and real world reasons, climate has been such a big topic recently, and I think investors have grabbed onto it partly because there's such a big hype around it, but also because it's the easiest to measure in many ways, and it's therefore easier to sort of see whether you're achieving goals and making differences and setting thresholds and all these sorts of things. Whereas it's much more difficult to measure certain social outcomes and governance outcomes. On the governance side, I see, in our client base certainly, I see that governance is usually the thing that investment professionals are sort of best versed on. And they've been thinking about this forever, and it's been, well, certainly post the financial crisis, it's been a very big focus on alignment of interest with shareholders, executive compensation. Like loads of governance issues have already played quite a big part in their kind of investment decisions. And what they'll often say when we speak to investment teams is, we've got the governance stuff, that's fine, but just how do we tackle the social and the environmental side? So I don't think, I think from what I've seen, that seems to have quite well developed. What I think perhaps hasn't been well developed is the articulation of it. So again, coming back to the point we were talking about earlier, investors are just putting pressure on managers to be very, very clear about how they're thinking about these issues and what they care about, what are their priorities, and what things are they likely to engage on. We haven't really talked about engagement yet, but that's a really big I guess kind of transition from assessing to then starting to engage, and we're starting to see that move a lot sort of more positively now. And there are some strategies for sure, like M&A strategies or distressed debt, where governance is a really, really central focus of what they do and always has been, and is unlikely to change. On the social side, I think we will get there. I think it's going to be slower because I think people are just going to sort out the climate kind of needs first before they tackle the social needs, which I think they see as slightly less urgent. We are seeing, again, from a regulatory perspective, so the EU has something called the EU taxonomy, which is an environmental sort of framework for measuring the extent to which your investment products kind of meet certain environmental economic criteria. They are working on releasing a social version of that as well. So I think we will see movement on the social side, but I just think it's going to lag climate by easily a couple of years.
Right. And so under the banners of social, what would be the sort of in the areas you're focusing on the key issues, and then similarly under governance, what you mentioned, obviously shareholder alignment and compensation. Yeah. Are there other areas that are sort of central in investors' minds currently?
Oh, definitely. I mean, on the social side, well, again, depending on the sector, but using your technology sector as an example, big focus on sort of data protection and privacy and everything like that, which there has been for some time. Really, really big focus on sort of diversity and inclusion and equity-related issues as well. And I think that's been globally has been quite a big issue. What I think is really, really interesting is the sort of regional differences between, I guess, attitudes and tolerances towards different social issues like diversity and inequality. And coming back to this point about ESG being very subjective, I think this is a very, very important area that it's sort of important to understand the different expectations of companies in different regions of how they will approach these sorts of issues. We see a lot of focus on stuff like human rights and labour standards, sort of modern slavery type disclosures and commitments. We see, what other quite big things? I'd say sort of like a customer protection. So firstly, sort of access to certain consumers, but also I guess you think against things like predatory lending, against anything that would kind of be detrimental to sort of customers. So a real range, but very much depends on the sector.
We actually had a very interesting example of a company which screens very well on an environmental front, but very poorly on labour rights. And that company is one that everyone will know, called Tesla. And we took a look at that about a year ago. They assumed it would be a no-brainer passing our ESG criteria, but what we found was they actually had some unions which were trying to be set up a number of years ago. I think the senior management and Elon Musk pushed very hard to not allow that to happen, and in fact, were reportedly fired a bunch of employees who were in charge of setting up that union. So what ended up happening is that while it might have screened very well on the environmental front, it screened very poorly on the labour rights front. And I think that's a very classic example of companies you might think would be an absolute no-brainer, but while they might be good in one area, they're very poor in other areas. And I know Amazon is investable, or has usually been investable with NZ funds. I think there might have been a change with that recently in our criteria, but Amazon again is a company which is usually very hard on unions and labour rights. So it's certainly very complex. You can't just assume a company such as Tesla is doing really great things to change the environmental side, but they have to sort of meet all the criteria.
Oh, absolutely, and I think you also see these sorts of issues being much more headline now than they would have been a few years ago, and I'm not sure sort of to what extent these have become global news like sort of stories, but there's the big P&O issue at the moment with the way that they've sort of removed a whole bunch of workers has become such a big issue that it's not just the risk of the issue itself to the investment opportunity, but also the sort of reputational and the shareholder risk, in that so many other shareholders cease to want to be a part of that then there is a kind of knock-on effect of it. So I think it's been it's the sort of mainstream element of some of these issues has accelerated how much they've kind of been important.
I guess the other dimension to it is greenwashing, and lots of commentary out there at the moment around, I guess, the risks of greenwashing and the idea that it sort of undermines the industry's credibility in ESG. And also then that creates complexity for obviously asset managers and other investors who are trying to understand what they're actually investing in, and if firms cynically try and present a particular way when in fact it's not the case. Is that how are your clients looking at that, and how do you sort of see that as a broader risk to the industry?
Hugely. I'd say our clients are looking at it really conservatively, and in that they are desperately trying not to be accused of greenwashing, and it's a really sort of important balance to strike in terms of doing enough but being clear enough about what's being done that they don't get that sort of accusation. Going back to the sort of regulatory point again, that's a big part of what these sort of classification style regulations are seeking to try and solve, which is remove that element of risk of greenwashing, because certain criteria will have to be met to sort of achieve different labels. What I think the risk is, and I think we've seen this happen, is that some sort of investment managers are so nervous about being accused of greenwashing that they will sort of under-target their product, if you like. So let's say we have a spectrum of 3 different kind of classifications, and they could probably stretch to be the most sustainable version. They might opt for the one below it just because they don't want to be accused of sort of not quite doing everything they need to do. I think that the result of that, the sort of unintended consequence of that, is that people aren't pushing themselves far enough, and we want a system, I think, that kind of encourages more sustainable investing and more sort of impacts on investing without putting fear into managers of getting it wrong. So I think we've got a little bit of work to do there, but it's a really, really big issue. I think people are terrified of being accused of greenwashing, and so if anything, take a more conservative approach of how they explain it.
Do you find that when you're engaging with your clients, and for example the issue that Andrew was talking about before with respect to Tesla, is that something you routinely find where that they will be looking to make an investment and then discover actually we can't proceed with this in spite of expectations that they could?
It does happen. I wouldn't say that often. I think the main thing to remember is that for products that aren't sort of labelled as ESG and trying to achieve a particular sort of sustainability objective, where the purpose is simply to consider ESG risks as risks like any other, and really you're only focused therefore on those where you think there'll be a material sort of financial impact. If there is an ESG risk that you think has no bearing on your investment and no reputational risk associated either, in theory there's no reason why you shouldn't go ahead with that investment. So it's unlikely, I think, that people get to the end of their due diligence process and suddenly find this huge ESG red flag and say, oh no, we can't go any further with it. Normally those things are very much on their radar already and sort of incorporated in whether they're willing to kind of go past that point. So I'd say I don't think it happens that often, but I think that the process that we've gone through with all of these managers has helped them to find those sorts of things earlier and understand what is relevant and what they do need to be thinking about, and so perhaps saving that wasted effort to find it at the last minute. But I think it's unlikely you find things at the very last minute.
Yeah.
That big.
And some, I guess, investee companies are on they're very explicit about the journey they're on to change the way that they're operating. And obviously there are oil companies that are transitioning to energy companies, and energy companies that are focusing on more sustainable forms of energy production as examples. And it would socially it wouldn't necessarily be a good outcome if we deprive those companies of capital.
Yeah.
So I guess investors need to look at take a longer term view in some instances.
Absolutely, and that's also one of the sort of arguments why simply excluding names that are sin industries, for whatever your definition isn't always the best thing to do, because the argument is that if you are a responsible investor, it's better that you're the shareholder than somebody who isn't, and that you might actually engage and encourage certain business strategy in a certain direction, or vote in certain ways in AGMs, or act in a more responsible way. So, like I said at the beginning, we don't usually see exclusion as the only thing people do these days, because it's usually exclusion with some sort of integration, and the ability to actually make a difference is obviously the most impactful thing you can do. So I think that kind of comes back to that same point.
Just on that,
go for an intro.
I was about to talk about energy as well, Stefan, so maybe we're talking about the same thing. And it's I think a good point you raised, Stefan, about depriving companies of capital, and certainly the oil and gas sector, and if I more specifically talk about oil companies in the US, have had a period where investors have been extremely tough on them, both from probably not getting good enough returns over the last decade or so. Oil price peaked previously in 2007, and then maybe the investment ramped up a little bit quickly after that. But then certainly in the last 5 or 6 years, as ESG has become more of a focus from investors, people have been allocating capital away from those sectors. And what that generally means is, if these companies are not getting capital, they're not going to reinvest in oil, which in some sense is really achieving what the goal is, which is to reduce our reliance on oil, reduce the production of oil. But then you sometimes have the consequence we're getting now, which is oil going to very high prices. We're getting really high inflation. And actually, I think last week there was a commission that was held with a bunch of senior senators and CEOs of oil companies, where they accused these oil companies of actually intentionally trying to or not drilling enough wells and not producing enough oil to try to push the oil price high. But the CEOs are then trying to defend themselves, saying, look, we've been very much pushed by our investors to be disciplined on drilling new wells and disciplined on supply. So we can't have it both ways. And I think this is maybe over the next year or two, as we go through this high commodity price cycle, we're going to get the tension between this of how hard is pushing an ESG going to actually cause other issues such as high inflation, and that creates issues that really impacts on consumers, particularly sort of lower economic or lower income consumers.
Absolutely, and I guess you'll start seeing the tension playing out in the approach investment managers need to take. Energy security, I was actually going to take a slightly different angle, which is just that energy security generally is really at the fore at the moment. Obviously, what's going on in the Ukraine is driving us to an extent. And is that changing the way your investment or your clients are looking at energy security, and how and where do you think that is that going to change the way that Europe thinks about its policy?
In terms of what's going on in Ukraine directly?
Yeah, or just in terms of right now, energy security is so central to thinking, and obviously in Germany and across Europe, and in some respects it's in conflict with some of the ESG approaches that have have been promoted up until more recently. And I guess the same can be said of armaments to an extent as well. But yeah.
Yeah. I mean, yes, we should talk about that as well. But on the anti-security side, I think Andrew sort of touched on this point. It's the same companies who are falling into the sort of bad energy as are making improvements and heavily investing in sort of renewables and taking this direction. And I promised you a stat, and I did gather a useful one. So just in this context of sort of energy and I guess kind of climate change and the impact it's having on it, the OECD have a bunch of research on this, and what they have said is that they expect 6.3 trillion of investment in infrastructure required annually between 2060 and 2030 to meet these sort of climate goals. And a lot of that is obviously focused on certain industries, including obviously energy, industry, transportation, those sorts of things, agriculture. So the economic sort of impact of that, and I guess the sort of it is not possible anymore to ignore these in any investment decision, not just directly in energy companies, is so huge. But I think it has to be in the way that everybody thinks about sort of economic paths. I don't think I know enough about sort of regulatory plans specifically on that, but
the covers are still being developed, right? So
yeah, I don't have my crystal ball on that one, but I think I can't believe it won't be a huge thing.
Yeah. Okay.
Do you want to talk about defence?
Yeah, let's do it. Let's very briefly. So obviously that's because generally defence spending has been, by many is considered to be until more recently an area that's commonly excluded, and now that's central to a lot of the thinking, and I guess that's caused some people to us to revisit what that means morally, socially, and so forth. Is that something you're seeing across your clients?
This has been a really interesting debate over the past sort of 6 weeks or so. It's prompted such a big debate about basically how far investment in defence becomes necessary in the sort of effort to protect human rights, democracy, and so on. And look, this is not to comment on whether we think this is right or wrong from a sort of political perspective, but the thing that we've observed is, and a lot of our clients do have some exclusions, and they specifically do relate to weapons, but usually it relates to specific weapons. So they will define this. Whereas other industries, they might just give a blanket exclusion, like tobacco, any production, distribution, gone. Whereas weapons, it's often a lot more nuanced. And so it'll be focusing on sort of illegal and controversial weapons. So nuclear, biological, chemical, cluster munitions, these sorts of things are specifically sort of called out here. And so those who do have those exclusions are not, I don't think, likely to change these sorts of things overnight. I think that they're very unlikely to just make changes based on geopolitical developments in general to these sorts of exclusion lists. I think you sort of set your lists and occasionally change. Those that don't have those sorts of exclusions and who are sort of sense checking whether or not they want to get into defence stocks or stay in defence stocks, I think for those who are able to conduct enough due diligence to be comfortable that weapons manufacturers are supporting defensive rather than offensive action, are making a really fair case for it. But it's a very subjective concept, and not all investors have that ability to kind of do that level of due diligence. It very much depends on the strategy. And remember, we work with a lot of kind of complex strategies or very, very fast-moving investors who don't stick in things for very long, like quantitative strategies or even convertible arbitrage type strategies where they're not really taking a view on a company, or M&A where they're not really predicting what's coming. So different strategies that don't have the ability to sort of do that level of due diligence, I think they're finding it harder to kind of make the to be able to justify to the investors that they're comfortable with it. Ultimately, though, I think from our client base, they're sort of responding to their investors' wishes on this. And if investors are very strongly opinionated, then they will honour that. And as long as their investors are comfortable, they'll kind of proceed. But I don't think we're going to suddenly see a bunch of exclusion lists changing overnight. I think that takes a lot longer.
Understood. Engagement, you mentioned earlier, and that's a growing area within ESG. And do you want to just talk about what you mean by that, and then how?
Yeah, definitely. And this is a really important thing. And I feel bad we haven't really sort of just touched on it until now because it is such a significant thing. So the sort of ESG, I guess the responsible investing kind of progression goes from identifying issues and assessing those issues to actually taking action as a shareholder and using your position as asset owner to be able to influence corporates. And that will obviously depend on your level of control and level of influence, and depends therefore on the product that you're holding. So if you're a private equity manager and you have complete control or majority ownership and therefore quite a lot of control, then you can mandate what companies do, and you can say, we have minimum requirements, we need you to collect these data points, we need you to take these actions. And so you really can use your position to make an impact and directly sort of influence change. If you're a listed equity holder and maybe lots of small positions, obviously less so, but you can collaborate with other investors, or you can participate with letter writing, you can vote at AGMs, there's lots of things you can do. For some strategies, though, that's very, very difficult. If you're holding a position through some sort of derivative instrument, you may not have any direct actual ownership there, very limited sort of as to what you can do. But it's a really important part of, I think, what the goal ultimately should be of a lot of this ESG is not just to figure out what the issues are and go away from it if it's a bad thing, but to sort of make the change if you have the position.
Yeah, which brings us back to that point about subjectivity you made at the very beginning, and about how if you are an investor and you're holding something, suppose you hold a small allocation in hedge shares to a security, and you want the business to make a change. That's a moral overlay that you're sort of adding to your investment decision, and obviously you're going to, in that setting, try and engage with the management of the investee company and encourage them to make the change. Obviously, if you're a PE company, you can just demand it, but for us, that's and for a lot of asset managers, that's not always available to you.
Yeah, no, absolutely, but it's the direction we're definitely seeing things going for those who are in a position to do so, for sure.
Yeah. Daniela, thank you. Hey, Mark, Andrew, did you have any other questions? No? Okay. Thank you so much for joining us. It's been a real pleasure to get your insights and views on things, and I wish you the best for what's left of your evening in London.
Thank you very much. It's been a pleasure to be here.
Great. Thanks a lot.
Bye.
All right. Well, let's transition over to Andrew and Mark. They're going to provide a portfolio update on developments in the markets and how we're looking at things.
Thanks, Stefan. I'll kick off and then hand over to Andrew, and I'll keep my discussion relatively big picture and really sort of talk about, I suppose, the key events in my area, which are really the path of interest rates over the first quarter. And we've generally seen some very large moves. If we look at, say, the US 10-year, that ended 2021 at 1.5%. Here and now this morning, it's sort of starting at 2.7%. So you've seen quite a large move, more than 1% over really what is just over 3 months. And that, that's been also reflected in New Zealand. You've seen New Zealand 5-year interest rates sort of move from sort of a similar type level. 3 years had moved up from around about sort of 2.7% to closer to 3.7%, and we're actually at the highest level we've seen since sort of mid-2015, so the highest for 7 years. So some pretty big moves there, and people may have also seen, I suppose the impact of interest rate moves like that is that it leads to some pretty negative performance for bonds in general. And there were some headlines that sort of said that in the US, that move in US interest rates sort of resulted in the worst quarterly performance for bonds in almost 50 years. Pleased to say at our end, we've talked a lot about the tools we had to try and mitigate that. That created some slightly challenging returns for us in the back half of last year. But pleasingly, we've been able to use those tools to capture, or certainly to mitigate, not only mitigate the return or the negative return in bonds, but actually start to profit from that. So the income-focused portfolios have had a very strong first quarter, you'll be pleased to know. I think the 2 points I really wanted to touch on in terms of the US interest rate move. So sort of almost two slightly competing implications. One is I'm going to talk about the trend in interest rates, and the other one is the shape of the interest rate curve. And in terms of the interest rate trend, we've very much seen a case that people see that. I think they can. Can I, Stefan? Yeah, good. In terms of the last, really since the mid-1980s, we've seen interest rates, and back in the mid-1980s, interest rates were at 10%. And, there's really been a very defined trend since then for interest rates just to move lower. And, we're a period of really almost 40 years of lower highs in interest rates and new lower lows each time in each part of the cycle. And as we move down from that sort of mid 10% down to the very lows that we saw in May 2020 of in the region of sort of 40 basis points. Now, what is interesting is as we move up to these sort of levels of 2.7%, we're really starting to, for the first time in a long time, challenge that downtrend, which makes sort of people question, really have things changed? Are we ending a 40-year cycle of ever lower interest rates? We're definitely getting at levels that are starting to question that. Given it's been such a long cycle, I think you need to be very wary of calling the end to that cycle too soon, but definitely there's some questions being asked there. And if we do see a break of that, that really would suggest that things are different this time, that the pattern of the last 40 years is changing, and that because of inflation and events around the world, maybe we are going to see a continual move higher in interest rates. Now, that may not be immediately, but it may be a pattern that happens over a number of years. If that does happen, the nice thing is we do have the tools to manage that and actually be well positioned. But against that, I suppose the countervailing comment is really the shape of the interest rate curve. And, one of the ones that's watched very closely is where 2-year maturities are relative to longer dated 10-year maturities. And in the United States, that has, again, over that sort of last 40 to 50 years, that spread between the 2-year and the 10-year has tended to range from at highs of up to over 2%. So 10 years are 2% above where the 2-year is, down to essentially zero or briefly negative. So where the 2-year is at least equal to the 10-year interest rate, or may even be higher. Now, we have seen, and very briefly over the last little bit, that spread move to zero and indeed move briefly negative. And what is interesting, and for those of you on the call who can see the chart, generally that period where you see flat or negative spreads tends to happen in advance of an economic slowdown. You definitely saw that back in 2019, so it was sort of a year ahead or a year and a bit ahead of COVID. You definitely saw that prior to the GFC in 2006, 2007. Likewise, you did see it again prior to the dot-com bubble in the late 1990s, 1999, early 2000. So it's been quite a good predictor of the probability of an economic slowdown, somewhere between 12 and 18 months ahead. And, given what is happening with central banks around the world, they are actively trying to slow down economic activity to rein in inflation. And, that 10-year spread is suggesting that in the US and probably around the world, we are going to see slower growth and potentially even some risk that we do move into recessionary type situations in sometime in sort of mid to late 2023, 12 to 18 months ahead. So, really that is a conflict, I suppose, of that or maybe in conflict of that other chart that suggests that we are sort of moving into a period of ever higher interest rates. The last one I wanted to touch on before I hand over to Andrew was really where New Zealand interest rates are going, and in the sense that we have the Reserve Bank on Wednesday come out with their latest, or sort of reviewing the official cash rate. I think the important point to note is this is not a full monetary policy statement. This is just an interim review, so there is no full document, and there is no press conference for them to provide more colour around what they're doing. Interest rates have moved up a lot, as I mentioned. We're now looking at, say, the wholesale 5-year interest rate here in New Zealand at sort of around about 3.7%. So that's moved up significant amount, and definitely is back to those levels as sort of last seen in really sort of early 2015. But I think what is important, or what is interesting, is really what that market is suggesting. The market is suggesting that essentially 40 basis points of hikes are priced in this time. So essentially there's a 160% chance of, or certainly 100% chance of a 25 basis point hike. That's a given. But there's also a 60% chance that they do more, so they do a 50 basis point hike. Again, because it is a interim meeting, I think that's possibly a 50-50 call, and myself, I'd go for a 25, but it's certainly feasible they do 50. But what is interesting is the market is currently pricing in really a series of aggressive tightenings coming forward, up to the point where we have 7 meetings between now and February next year, and 10 interest rate hikes are priced in. And by the end of the year, the market is expecting somewhere between sort of 3.2 and 3.5% as being the OCR. And if you think today, here and now today, the OCR is 1%. So that's an aggressive hiking cycle that the market has already priced in. Clearly, the Reserve Bank will hike and continue to hike, but I think there are question marks over whether we need a hiking cycle that is that aggressive. But we'll see on later this week as to what their views are, at least in terms of the statement, and that'll be sort of towards late May before we see a full statement from them where they can talk about their views more fully. With that, I might hand it over to you, Andrew.
Thanks, Mark. I'll take you through some high-level thoughts on the equity market and commodities market, and I'll kick off on equities. And the key theme that we've seen over the last month has been continued volatility, and I think this is a reflection of the changing environment we are. If we just step back and zoom out to the last 2 years, we were, for the most part, sitting in an extremely favourable environment for equities. Following COVID, we had extremely easy monetary policy, low interest rates. We had a lot of fiscal expenditure by governments around the world, and this drove a very sharp period of economic growth, and was a very favourable environment for outperformance in the share markets. What has happened this year is that is all changing now, and I'm not necessarily saying this means we're going to see very, very negative share markets, but what it means is that uncertainty is very, very high. So the environment we're in now, as Mark has just talked about, is increasing interest rates, and that has been going up very fast, and particularly over the last month, we've seen an extremely fast move higher in nominal interest rates. Now, this is coming around because of the high inflation levels, and high inflation levels is typically something which makes uncertainty in share markets higher as well. It is often coincides with slightly more negative periods in share market returns. And then to add to this as well, we've now got a major war in Europe, the largest war we've seen in Europe since World War II. We've written a little bit about wars in the last few weeks, and wars are not always bad for share markets. In fact, if you go look at a lot of analysis in the sort of year or two after wars, they can sometimes be quite positive, because it creates a lot of spending and expenditure, and it gets the economies going. However, the difference we have at the moment is that we have a war going on when we're already in a tough inflation point. So often when a war starts and you've got low inflation, that means you've got room to expend low interest rates and increase expenditure, and then it all of a sudden gets the economy going. But at the moment, things are a little bit difficult because central banks cannot just lower interest rates. We actually need to do the opposite to control inflation. So you put all this together, what it means is that we've just got a highly uncertain environment, and that's been reflected in share market volatility. We've seen some big moves down so far in this calendar year, but we've also seen some sharp rallies back really higher. So I'll just share a screen here and give you, for those that are able to look at the video, and give you an idea of what I'm talking about with this share market volatility. So the first chart I have here is the S&P 500. As you can see, throughout most of 2021, we had a very strong move up, and that was a continuation of the move that we had in 2020. But right around the start of this year, we started getting some very, very sharp moves down. In fact, we actually bottomed in the S&P 500 down 13%. And then as of mid-March, we've posted a very big rally, up about 11%, which is now just beginning to fade. I wouldn't get too worried about the movements. What we're really trying to say is that volatility is high, and that is a reflection of the market being quite uncertain. The NZX 50 has been a little bit less volatile, but we certainly saw a very sharp fall right at the start of January, and then since then we've really bounced within a range. We're now sitting down about 7 or 8% for the year. We didn't quite get the sharp 10% bounce that we saw in US markets over the last few months, and that was largely because it was very much a growth stock-led bounce. It was kind of your NASDAQ 100 stocks, your big tech names that drove that bounce in the US, and the New Zealand market has much less exposure to that. I just want to jump into commodities, and then I'll bring it back a little bit to how NZ Funds portfolios are positioned. Commodities has certainly been one of the best asset classes to be involved with this year, and it's actually going back right through 2021. They performed pretty strongly, but around about the start of the year, the commodity index performed very well. So the chart I've got up here is the Bloomberg Commodities Index. Now, this is a broad representation of most of the major commodities used in the world. So it's got oil, gas, it's got key metals such as steel, copper, aluminium. It's got agricultural commodities such as corn, soy, wheat. And as you can see, that this commodity index from the start of January actually rose 28%, but had a very sharp rally from around about when the Ukraine war announced on the 28th of February and rallied sharply at that point. Since then, we've seen a small retracement. We're still up a lot since pre-war and the start of the year, but we've had a little bit give back. A lot of that has been driven by oil price, which I'll jump to on my next chart. As you can see, oil price spiked very high just after the Ukraine war. It rose from about $90 up to over $130. I think the intraday peak was over 130. It's now come down to around about $100. I'll just stop sharing the screens here and sort of tie this into how we're looking at the markets. Given this high share market volatility, given the amount of uncertain risks that we're facing, such as high inflation, interest rates, the war in Ukraine, it's an environment where we believe we shouldn't have too much exposure to share markets. And so what we've done most this year is we've been a little bit light on our share market exposure. We certainly haven't been positioning for a very big crash such as we saw in COVID when share markets fell over 30%, but we've been a little bit lighter, and that means in our inflation category we've taken those portfolios back a little bit more. The growth categories have come back a small bit as well. But what we're very focused on is using our ability to invest in commodities to generate returns, because this is a fantastic environment for commodities. What has really been driving the commodity markets is a multi-year, almost decade period long of underinvestment in commodities, which has made them extremely tight from a supply perspective. So the fundamentals, right from oil, gas, through to metals like copper, and in some of the agricultural markets, has been extremely positive even before the Ukraine war. The Ukraine war has now served to actually tighten all this a lot more. I won't get into too much detail on this because we're running out of time, but we've written about it, and it has made the bull case of commodities even stronger. So against this backdrop, our NZ Funds performance so far calendar year to date has been very strong. both our growth and inflation category portfolios are up towards the double-digit percent returns since the 1st of January against share markets that are down generally between 7 to 8%. And that's very much a reflection of our strategy, which has been a little bit light on the share market exposure and a little bit heavier on the commodity market exposure. We continue to take that approach at the moment. We'll respond and change these exposures if we see the environment move materially, but for the time being, we consider this to be the balanced approach and approach that can perform in these markets. So I'll pause there, Stefan, and hand back to you.
Thanks, Andrew. Thank you, Mark. Great to get a bit of an update on that front. Thank you, everyone, for joining. We've run the course for today, but we look forward to seeing you again, same time, same place next week. Have a great weekend.